Welcome to the Tech Today podcast. It's your host, John Mayetta. The Fed has left us with a stagflationary setup. So we wrote a book about stagflation in 2021, which I'll link to here in the show notes. I believe we've been in the stagflationary environment here in the United States since 2022. What is stagflation? Stagflation is when you have muted or negligible real GDP growth, or negative GDP. Real GDP bounces around zero, essentially. You have elevated prices, and you have a high debt level. And of course, we're at a $34 trillion debt level. And so the Fed yesterday announcing an end to rate hikes, that dovish policy, they just ease monetary policy. So now you're going to have inflation creep back into the marketplace. Now, granted, the economy is softening at the same time, so there's downward pressure on prices with the softening, but with the ease of monetary policy, that puts upward pressure on prices. So net, you have elevated prices. With the consumer pulling back, GDP is sliding, real GDP. I wouldn't be shocked if we have a real negative GDP print early next year. And you've got the $34 trillion debt load, which costs approximately $1 trillion to service. Fiscal 2023, I think we spent roughly $900 billion servicing the debt. That number is going to be higher in fiscal 2024, unless the Fed cuts rates to zero overnight. But as those short duration Treasury bills and medium-term duration bonds, as the Treasury securities in the marketplace start to mature, and as the Treasury has to issue new securities, those new, whether they be bills, bonds, or notes, those new securities are going to be issued at a higher interest rate than they were when the security that they were replacing was issued. Right. So the average interest rate on Treasury debt is creeping up. And so last year, the cost of servicing the Treasury debt was approximately 20% of federal receipts, incoming tax flows. And next year, that number is going to bump up to closer to 25%. So this mountain of Treasury debt, this $34 trillion of Treasury debt, is crowding out spending. And that number is only going to climb, that $34 trillion. My guess is we run a fiscal deficit of $2+ trillion in fiscal 2024. So we have a mountain of debt that's frankly unsustainable. And it's growing faster than GDP, growing faster than inflows, tax receipts to the government. So it's not a situation you want to be in. If the United States was a corporate issuer, it would be, frankly, it'd be in default, right? I mean, if it took away its ability to print, it would be in default. And the way we're going, 99% of the U.S. dollar's value versus gold has been eroded since we came off the gold standard. And that last 1%, and we're just eroding that. And so yesterday, Fed says, okay, we're essentially done with rate hikes. Let's see what they do with QT. The QT numbers come out today at 4:30 p.m. East Coast time. We've written earlier that perhaps the overnight reverse repo market is an indicator as to when the Fed may be done with QT. The overnight reverse repo balance has been steadily declining. It's more or less flatlined in December, right around $800 billion, down from a high of $2.6 trillion. So as that excess liquidity bleeds out of the market, that may be an indicator as to when the Fed will wind down QT. Or maybe they halt that in the next few weeks. It's difficult to tell. But we have a dovish Fed. And now with this dovish stance, yesterday's dovish meeting, we're allowing inflation to creep back into the economy. So there's no way that we get to a 2% CPI and hold it there in the near term. That core CPI number is going to be stubborn at around 3%. Now that the Fed's ease policy, it's going to be that much more difficult to get that core CPI number down. So higher prices are here to stay. Meanwhile, the consumer is softening. You have companies like Spotify and Etsy, and there are going to be many more cutting heads. Spotify announced a 17% reduction in force last week. Etsy was 11% this week. You're going to see a lot of announcements after the first of the year. And what doesn't get announced after the first of the year, you'll see kind of the second half of January, first half of February, when public companies report their Q4 earnings. A lot of companies will save the headcount announcements for the earnings call. So you're going to see conservative guidance from companies as the consumer pulls back. As the consumer pulls back, that also hurts companies that play in the enterprise side. Corporations who may not deal with the consumer, corporations who sell to other enterprises. When the consumer pulls back, it impacts all sectors of the economy. So if you look at my old space, if you look across technology, whether it's enterprise software, consumer-facing software, broader technology, information services, what have you, all these companies are going to issue conservative guidance for 2024. And for Q1 would be my expectation. And so as this is happening, the Fed is becoming more dovish. If you look at the equity markets, historically, the equity market doesn't bottom until the Fed begins to cut. So that hasn't happened yet. But at the moment, as you would expect, equity prices are lifting. Commodity prices ought to lift now that we have more upward pressure on prices, more inflation creeping back into the market, given the Fed's stance. Dollar ought to trade down versus other currencies now that we're in a position, the United States is in a position where it's probably going to have rate cuts. I don't know about Q1, but perhaps as early as Q2. And so that makes demand for the dollar less vis-a-vis other currencies. So the dollar is going to weaken. And it just creates a very interesting backdrop and setup for the markets, for the economy in 2024. But for sure, we now have a stagflationary environment, which is not good, by the way. It's good for equities for now until investors start to look at the fundamentals. I think after the Q4 reports, when companies talk conservatively about their outlook, and when that outlook doesn't change for the better in April on the Q1 reports, and perhaps that outlook softens in Q2 when companies begin to report Q2 results in July, we could really see the market, the equity market, trade back. I think the fixed income market, I could see the fixed income market taking share of investor dollars from the equity markets, because as things start to soften from a fundamental standpoint, from a business activity standpoint, you'd want to rotate out of equities into fixed income securities where you have a credit claim on a company as opposed to just a straight equity share. So I could see the bond market doing well. Of course, it is doing well since yesterday's news, but I could see that persisting, that trend persisting. As I said, you'd expect to see commodities do well insofar as the Fed maintains its dovish stance. This is not good. The way you fix a stagflationary environment is especially the environment that we're in, given our mountain of debt load, you need to radically reduce fiscal spending. I just don't see our government doing that, not in an election year. I could see Biden wanting to push through a stimulus, perhaps around the 4th of July holiday. I've talked about that before. You don't want to do it too soon, lest people forget, lest voters forget. You can't do it right up against the November election, but the 4th of July holiday, wrap it in some Make America Stronger type label. But I could see them trying to push through a stimulus. I don't know that a GOP-led House is going to want to push back. I think the GOP ought to have a conversation with the American people as to why more stimulus is not a good thing, as we don't have the money to hand out to people, into government, into companies. Number one, in order to execute a stimulus plan, we have to print the money. And anytime you print money, you're diluting the currency, you're devaluing the currency. So you're creating inflation. And so any quote unquote government stimulus plan is by definition inflation inducing. But I just don't think the GOP is going to have that conversation with the American people. I think what they'll end up doing is, oh, don't want to be seen as the bad guys around the time of the election. Therefore, we will pass an inflationary bill, a stimulus bill through the House. So I could see 2024 being a year where we make our stagflationary environment worse. We increase the debt load through stimulus. We induce inflation through stimulus. We crowd out spending in other areas because more dollars have to go to pay down the debt, to service the debt. And so the Fed really didn't have any choice but to halt rate hikes and eventually to take that Fed funds rate down, because we simply can't afford the debt that we have. The Fed really was in a tough spot, but it didn't help itself back in 2020, 2021, and 2022 when it was full steam ahead on QE. The Fed created the box that it finds itself, well, it created half of the box that it finds itself in. The other half of the box was created by fiscal policy. Not an envious position for the Fed. And at the end of the day, who suffers? The consumer. The Fed could talk about all it wants about how it vanquished inflation and has CPI well on its way to 2%. But the problem again is, and I sound like a broken record on this, is given the price increases, the real world price increases for goods and services, which are much higher than what's been reported by the CPI numbers over the past couple of years. Given those massive price increases, knocking CPI down to 2% isn't a win, because we had price increases move up in a massive step function. So the fact that prices are flatlining, that's not a win. The American people are still suffering. We put out a note a couple of days ago on PPI. Eggs, for example, are up 70% month to month at the producer level. So it's regardless of what the Fed said yesterday, it doesn't feel any different. It's not going to feel any different in the real economy. The Fed hasn't vanquished inflation. Inflation's here to stay. Yesterday was bad news. Unfortunately, that's all for now. See you next time.